Paramount Global operates a mass media company, creating and distributing content. Under the profitability section, we can find a somewhat low gross margin and what is historically for this company and for this industry, a low operating margin, less than 6%. But to the left under valuation, this is getting to be very rock bottom price to sales or enterprise value to sales. Investors clearly aren't happy with this depressed profitability. In almost all situations, that would be the end of the story. But in the case of Paramount Global, something very fascinating and unique is going on with its debt. Taking this last row in valuation, total debt to enterprise value, this ratio very much implies that the debt is manageable. Yet under the capitalization table, the total debt to total assets, the total debt to total capital, and most importantly, the total debt to total equity rarely get this large. And so from a financial valuation point of view, the company is not very levered financially, but it is remarkably levered operationally. A very high, -31, almost -32% return on equity is almost surely a result of this operational leverage. And so pulling this all the way back up to the top, and we will be looking at lots of different contexts in order to make this crystal clear by the end of the video. What I think we're going to learn is that this operating margin, which we said was low immediately, 5.5, is bleeding through the operational leverage into very ugly numbers right now. But it must not be very far from 5.5 if this capitalization figure is accurate. Operational leverage, it affects you on both sides. So let's keep going through statistics on this business. Today is May 20th. The current stock price is $11.76. Looking at a big old table of additional statistics thanks to finviz.com, the number of shares outstanding today is 633 million, meaning that this company does have a market capitalization of $8.3 billion, which actually makes this the smallest of the major American media companies. I am, of course, talking about peers right up here. Finviz is suggesting we compare this to Disney, that we compare this to Comcast, sometimes known as Peacock or NBC Universal, Warner Brothers, Netflix, as well as some foreign competitors like the Sony Group. All of these are almost an order of magnitude larger than Paramount Global currently is, at least in terms of market cap, with the exception of Warner Brothers. Warner Brothers and Paramount are lagging behind the market caps of all these other competitors. After watching this video, feel free to check out my Warner Brothers series as well. So what I'm immediately noticing here is that there's a good amount of green on this left side, which is typically the analyst reactions and the analyst pricing the future. And the valuation ratios, like we were just looking at over at MarketWatch, are rock bottom prices. I mean, a 0.29 price to sales is almost unheard of for a almost $10 billion American international company. Analysts are expecting the profitability to happen. We just talked about how operationally leveraged this business seems to be, meaning that if this forward PE really is positive and low, this is seeming to have the hallmarks of an explosive turnaround story. If this does not turn around, the current return on assets, return on equity, return on investment are operationally leveraged. These are very large negative returns. As a result, earnings per share this year have fallen by -18.5%. If the company doesn't turn around, and relatively soon, it's not clear how sustainable this situation actually is. As a result, going all the way to the right column, this is the performance of the stock. The stock is actually up year to date, but down with a 1 year ago comparison. None of these numbers are that eye-popping though, but this basically means is that the stock price has stayed relatively flat, especially compared to the rest of the market. Let's scroll up and actually see the Finviz chart. As of today, May 20th, we're in the upper third of what seems to be a barely increasing moving upwards channel. But actually, for only the second time in recent memory, we have the 20 short moving average above the 50 short moving average and the 200 moving average. That combination of short-term, medium-term, long-term, all on top of each other, had not happened a single time in the second half of 2024. The way this chart's looking, I wouldn't be surprised if it hadn't happened at all in 2024. The reason I'm showing you this right now is that the technicals actually are now aligning very recently to something that looks like a constructive stock price. We are going to go through quite a couple of sources before finalizing on the annual report the company's own explanation of how it's doing. Let's dive in so that your wisdom can blossom.
This video is intended for educational purposes. Opinions made by me or the Sage Seeds AI are not investment advice.
Well, the New York York Post, which I will tell you has historically had a bit of beef with some of Paramount's CBS news network companies, isn't necessarily writing hit pieces in this day and age. But here on April 28th, 2025, New York Post posting that 60 Minutes, well, their host, Scott Pelley, is directly calling out Paramount in a shocking on-air attack on CBS's Paramount company. That is one of Paramount Global's most high-profile, kind of lifelong generational employees, using his clout and platform to directly criticize our potential investment. Legendary 60 Minutes correspondent launched an astonishing on-air attack on his Paramount bosses for interfering with the program's coverage. So we're talking about reputational risk. Pelley went rogue at the end of Sunday night's episode, which appeared to be a simple tribute to Bill Owens, a longtime 60 Minutes executive producer who quit the week before over the company's heavy-handed interference. More than one employee. This was directly in relation to Trump suing 60 Minutes and demanding a retraction for an interview that 60 Minutes did in 2024 with presidential nominee Kamala Harris, if you guys remember her. This was actually headlining the New York Post's U.S. news section. I mean, think about how much news is going on in the world right now, how much U.S. news is happening. It's shocking that this was a headliner, but that is really how important this is as a reputational risk. And so now let's move on. 47 minutes ago, published on Guru Focus News. It's been a few weeks since the last article, and Paramount CBS's news organization is not doing much better. Leadership shakeup at CBS as the CBS News CEO, Wendy McMahon, resigns. This marks a significant leadership change, and her departure is expected to have implications on CBS's strategic direction. So continuing along, now on tipranks.com, the CEO had not resigned when this article came out just 4 days ago or something, but expected mass layoffs as CBS News pairs its staff. Here we have a story highlight. Love these. Paramount may have some layoffs coming and already let 3 people go from CBS News. For a while, one thing most believed about entertainment giant Paramount was that CBS and CBS News, by extension, was safe from layoffs ahead of the merger with Skydance. But a new report from the New York Post, which, I'll add, remember, this is historically the main rival in New York City for CBS News. But a new report from them says that, in fact, CBS News quietly trims staff before what is expected to be another round of mass layoffs in summer 2025. Last week, people were saying that CBS News fired 3 people described as being in high-level positions, including 2 CBS News bureau chiefs and a senior executive. Now, in the last month, 6 weeks or so, this is now beginning to look like a full-scale purging of the executive leadership at CBS News. Both the North Bureau Chief, Andre Rodriguez, and the Southern Region Bureau Chief, Marhelen Campa, were cut. It was described not as a purging, like I just said, but as a streamlining move, a part of organizational changes to centralize the internal news gathering process. And so all that's going on the East Coast, but Paramount really is a global and huge company, and so a lot of what happens with it is going on in Hollywood. And so let's go to California, May 8th, 2025. Over here, the Hollywood Reporter is talking about the Hollywood CEO pay mega chart revealed and one big golden parachute. Now here is, for people that know Paramount Global, here is the ex-CEO of Bob Bakish wearing a very obvious golden parachute. He was given a financial golden parachute, and the memers are gonna meme. Hollywood Reporter says, with his severance package alone worth $69.3 million, more than the total pay packages disclosed for any other industry player, Bob Bakish, the former CEO of Paramount Global, was catapulted to the top of the annual compensation list. The 3 co-CEOs who succeeded him all received packages in the $20 million range. I mean, yeah, they together still are earning less than Bob Bakish. As co-CEOs, they made $6 million each, with the rest of their compensation being paid for their respective existing and continuing executive roles. And so you have each co-CEO making literally a tenth of what the previous CEO was making just last year. Now, a bunch of executives are finding that their contracts are not being renewed. But let's zoom it out. Thanks to the Hollywood Reporter, we have a leaderboard of all of Hollywood. So Bob Bakish right at the top. Now, this is a 2024 numbers in red and 2023 numbers in black. And so, I get it. It's a little ridiculous. I mean, it's his salary more than doubles. Next up, we have the co-CEOs of Netflix, Ted and Greg, both making really almost the same as Bob Bakish. package. Then in fourth, we had Warner Brothers Discovery. Fifth, we have the Disney CEO, which just returned actually, at SiriusXM, Comcast, TKO Group, Roku, and now we have the new CEOs of Paramount. And so Paramount is cutting salaries at the very highest level, which if we go back to what we were seeing financially and operationally, I think these guys are taking these sizable pay cuts, and I'm talking about George, Brian, and Chris, because they must see what I see. Paramount is financially able to cover its debts, but it's operationally massively leveraged. If they can get Paramount to just be even a tiny bit profitable, the operational leverage will more than pay off for this short-term hit in their salary. But in my opinion, they're certainly aware that Paramount is an explosive turnaround story. Still less than a week ago, updated May 18th, 2025. What are other large successful investors like myself saying? Well, Paramount Global shares acquired by Lighthouse Investment Partners. Lighthouse lifted its holdings in Paramount Global by 246% in just the fourth quarter of 2024. Other institutional investors that are buying or selling are really all buying. Vanguard Group growing its position by 1%, but it already had a massive position. Legato Investment grew its position by 3.7%. It owns over 44 million shares, which is about 6 or 7% of the company's entire market cap. Invesco owning 20.5 million shares. It's about 3.5%. Geode Capital owns over 15 million shares. And finally, Ariel Investments, which is probably the most high profile of all of these actually, despite being at the bottom of this list, is also hovering around 14.6, almost 15 million shares. And these are just the top 5, right? Overall, institutional investors own 73% of the company's stock, because Wall Street very much hasn't abandoned Paramount Global. So now let's go over to Yahoo Finance. This was May 15th, 2025. Roku versus Paramount Global. Which streaming stock is the better pick? Paramount Global has to rebrand itself. Now, is Paramount Global a streaming stock? No one really cares. And that's part of the problem, is that you compare Paramount Global to Roku. Well, that's a little bit interesting. Most people still aren't at the point where they think that's an obvious comparison. Let's look at Yahoo Finance, which is really kind of, plucking this from Zacks.com. Roku and Paramount Global are both competing for dominance in the ad-supported streaming space, but their recent performances paint contrasting pictures. Roku continues to scale its platform and expand its advertising toolkit, while Paramount Global leans on franchise content and viewer engagement across Paramount Plus and Pluto TV. So the case for Roku stock. Roku's ad-supported streaming business delivers strong momentum in the first quarter of 2025, driven by an expanding platform scale and innovative advertising strategies. Platform revenues grew 17% to $881 million. Roku now reaches an excess of half of all U.S. broadband households, with its home screen serving as the lead-in TV for more than 125 million people daily. But ad activities outside the media and entertainment vertical outperformed the OTT ad market. Roku is improving its ad measurement capabilities through integrations with third-party platforms like Adobe and Incremental, as well as launching its more accessible small business platform, self-service Roku Ads Manager. I do encourage anyone to look at below. I am linking all of these sources in the description of the video. The case for Parastock. Paramount's ad-supported streaming ecosystem delivered mixed results in the first quarter of 2025. Paramount Global watch time per user increased 17% year over year, and Pluto TV achieved its highest consumption ever with a 26% year over year increase in global viewing time. Very important strategic difference for Paramount. However, the advertising performance within the digital video segment revealed emerging challenges. DTC advertising, direct-to-consumer, revenues declined 9% year over year versus Roku's 17% increase that we just saw. The company acknowledged that these supply-demand dynamics have yet to stabilize, but it remains confident in future monetization, noting that the current digital advertising softness has yet to show signs of meaningful recovery. That specifically refers to wait until upfronts. We'd rather not have ads today than fill those ads and then not be able to sell to premium partners. So looking at the stock prices, blue is Roku, red is Paramount. The green and orange are different indices that these companies belong to. What you can see is Paramount is right at the bottom, Roku is right at the top. Here in a second graph, we now have I believe this is PE ratios of Paramount and Roku. Roku has expanded from a 28 PE PE ratio to a almost 34 PE ratio, whereas Paramount has stayed largely flat over this entire time period, like we were saying at the very beginning of the video, basically in consolidation purgatory. Here we have the analyst estimates for Roku. This chart's a little bit confusing in my opinion, but the black is the Roku stock price. Just I would say ignore that. And then I'm going to walk you through what the future earnings estimates were for Roku. In the year 2022, in red, analysts expected Roku to just have declining earnings. By 2023, in blue, analysts got even more pessimistic. But by 2024, analysts completely changed their story. This is where the PE ratio of Roku absolutely doubled or tripled almost, and it has stayed very high since 2024. And then in 2025 and now for 2026, earnings are expected to just be almost at the levels that they were back in 2022. Meanwhile, the same chart for Paramount Global, in red, we had the earnings estimates in 2022, decline. In 2023, in blue, even more aggressive decline. In 2024, this kind of like teal color, the earnings estimates stabilized. They were expected to basically be flat in 2025 and 2026. Now, analysts are basically expecting flat earnings. What's interesting though is that with Paramount, you can see the earnings estimates directly affect the stock price. I mean, as soon as earnings estimates became flat, the stock price became flat and has stayed flat. Feel free to read the whole article on your own. We're now going to move on to my favorite part, the part that distinguishes this channel for now at least. Paramount Global's 10K annual report, headquartered in 1515 Broadway, New York, New York. Let's see what the company's own words have to say about all this craziness swirling around them. This is a streaming company, therefore I want to look at its days to content ratio. This is something that I've been talking about. I haven't really seen anyone else talk about it for some reason, even though it's been a couple of years now. But I'm pioneering this idea that just like you would calculate days to sales for a retail company, I think streaming services should be really hyper-focused on their days to content. So let's calculate that together right now before we look at what the management's letter has to say. We're going to take current asset programming and other inventory, add it to long-term asset programming and other inventory. While scrolling up to the income statement, that 15.3 billion happened in the same period that revenues were 29.2. So I'm going to use a calculator for that one. But that gives us a ratio of 0.525 times 360 days in a financial year. This puts us at 189.2. Now, if this is less than a year, which it very much is, it's getting close to about half a year. Well, just like in days to sales in a retail business, that means you got a increasing operating margin over time. And this is really the case with Disney, it's the case with Warner Brothers, with Comcast. It's the case with every major streaming stock except Netflix, which check out my video on Netflix in which I explained exactly why Netflix takes 2 or sometimes 3 or 4 years to renew its most successful streaming TV shows. Well, it's because of this accounting, in my opinion. Paramount Global is right at the tippy top of this pack. Paramount was about 195 or something last year and has just once again lowered it to less than 190. That's beautiful. I don't know what's the lowest this can go. I don't really know, but the lower that number is, the faster operating margin is going to increase. Paramount in particular is so operationally leveraged right now that is the only thing they have to focus on. Well, guys, I was a little bit worried about this. You know, they've had a crazy year for the CEO. The CEO was ousted and replaced with 3 co-CEOs. And as a result, this is one of the most poorly put together annual reports I've personally seen. No offense to Paramount Global. I'm sure they're trying, but basically it's just boilerplate. There's nothing really substantial here. So we're not going to spend much time in the annual report in this video, unfortunately, just because I'm not going to read a bunch of boilerplate to you guys. I respect you guys too much to do that. However, the one juicy thing, you know, I appreciate they put right at the beginning of the item 7, Skydance transactions. I mean, at least they're acknowledging the transformational merger that's going to happen. Last summer, Paramount entered a transaction agreement with a company known as Skydance Media, which is an animation and technology company. There's 2 tiers of compensation for owners of not Paramount stock, but owners of the parent company of Paramount. Definitely look into, I mean, lots of people just won't invest in Paramount because of this, so I don't want to like gloss over it. It's just that we talked about it in previous videos. I'm not too worried about it other than the fact that the transaction as it currently is stated has a second level of compensation if the new Paramount Global stock rises to above $30.50 per share 5 years after issuance. That's more or less what the people negotiating this transaction transaction think is a reasonable middle ground for the expectations of the stock price. If new Paramount doesn't reach $30.50 per share, the people that have sold Paramount today miss out on a really, like, most of the compensation for the stock. It's actually like, this says it's half, but it's half of like triple the price. So it's like 2/3 of the entire purchase price only gets paid out to the people selling if the stock price goes up to $30.50 for all shareholders. That would be about 3 times higher than the current stock price. But in addition, whether that happens or not, Skydance is going to pay down 1.5 billion worth of the debt. All in all together, that will actually decrease the operational leverage to a certain degree, which is, like, a lot of people actually love that part of the transaction. I personally feel like if you're going to be an explosive turnaround, like, just commit to what you're doing. And I think this is the only part that to me seems like them hedging their bets, like, in case the turnaround doesn't work. It's not the worst thing ever. Plus, I'm not going to complain if they give shareholders $1.5 billion. And the rest of the transaction is really just down to whether you think Skydance is a good fit. And I got to admit, they do different things. Like Skydance does video games, for example, as well as big ticket animated movies. The only animated movies that Paramount does are some partnerships with Lionsgate and, of course, Nickelodeon Studios. I doubt Nickelodeon Studios is going to be cannibalized by an additional animation studio. I mean, Nickelodeon Studios is got such strong intellectual property. If you want to do a Nickelodeon movie, you're going to do a Nickelodeon movie regardless of what the other studio is doing, in my opinion. And yeah, I think Paramount would be a gold mine for video games. Will Paramount and Skydance, new Paramount, become one of the top video game stocks? Realistically, they might. It definitely depends on how the Annapurna Interactive, which is a subsidiary of Skydance, how their upcoming video games do. That video game does well, and the merger goes through, well, we might be seeing a wave of Paramount IP in the video game sphere. This is a turnaround story in real time. It has all the hallmarks that I think right now, May 2025, June 2025, is probably the right time to do a deep dive on Paramount Global. Well, I'm going to go take a break, but I had a lot of fun. Please consider liking and subscribing if you did too. I'll see you in the next video.